Hello and welcome to Simplicity in Stocks. In a market where everything rallies, hype often runs faster than fundamentals. Too many penny stocks move on speculation and not substance. And yet, these stocks can throw up exciting profit making opportunities. But finding value in penny stocks is tricky. The difference between hype and value can be razor thin. But spotting the difference is where the potential payoff lies. Here we cover 4 fast growing penny stocks that you should keep on your watch list. Please note that this video is for information purposes only. It's not a stock recommendation and should not be treated as such. There is no opinion or view on any stock covered herein. Suzlon Energy. Suzlon Energy is India's most prominent homegrown wind turbine manufacturer. The company has been central to shaping India's wind energy landscape for over 3 decades now, with over 20 gigawatts of installations worldwide. Its integrated business model spans design, manufacturing, project execution, along with operations and maintenance, giving it a strong competitive advantage. Over the last 3 years, Suzlon has posted a sales CAGR, that is compounded annualized growth rate, of around 18% and profit CAGR of 194%. This reflects the benefits of its scale and efficiency. In FY25, Suzlon delivered another strong year with 67% growth in revenues and steady margin gains. The company exited the year on a firm footing with debt-free operations and improved cash flows. Its O&M business, covering more than 15 gigawatts, continues to provide stable annuity-like earnings, while the manufacturing arm has a 4.5 gigawatt capacity. Suzlon has entered FY26 with an order book more than 5.7 gigawatts, the highest in a decade. Its flagship S144 turbine alone accounted for more than 5 gigawatts. Q1 FY26 was record-breaking, as the company delivered projects worth 444 megawatts, the best first quarter in the company's history. The management has guided for about 60% year-on-year growth in FY26 with high utilization and improving demand visibility. For investors, the big question is whether Suzlon can sustain this pace of execution and also protect its margins from competition as it scales up. Snowman Logistics. Snowman Logistics is India's leading cold chain logistics firm. The company operates 43 warehouses across 20 cities with more than 1.54 lakh pallet positions, supported by a fleet of over 600 specialized vehicles. It's a subsidiary of Gateway Distriparks, which gives it a strong backing in multimodal logistics. Snowman Services covers temperature-controlled warehousing, refrigerated transportation, trading and distribution, and increasingly, fifth-party logistics, that is 5PL solutions. The company has delivered a 3-year sales CAGR of around 25% and a profit CAGR of around 65%. In FY25, revenues from operations grew 9.8%, aided by a 26% jump in the trading and distribution segment, as well as steady gains in transportation. However, EBITDA margins narrowed to 16.8% from 21.2% a year earlier, reflecting serious cost pressures. Even so, warehouse utilization stayed at a healthy 91%, showing that demand remains strong across its network. It has added new temperature-controlled facilities in Kolkata and Krishnapatnam, as well as asset-light warehouse in Kundli in NCR, which has increased the overall pallet capacity to 1.54 lakhs. In FY26, it is adding more capacity in Kolkata, Krishnapatnam and Kundli, along with a push into 5PL, where marquee clients such as Unilever have already signed up. The company's future will depend on how well the management executes these growth plans. The margins need stability, but utilization is strong, and cold chain demand is rising in India. The big question is whether Snowman can turn all these capacity gains and 5PL wins into steady earnings growth in the future. All cargo terminals. A part of the all cargo group, All Cargo Terminals is one of India's largest private container freight stations, CFS, and inland container depot, ICD operators. The company runs 7 facilities across Mumbai, that is JNPT, Mundra, Chennai, Kolkata, and Dadri, with market leadership in JNPT and Mundra. It handles nearly 6.8 lakh TEUs annually. The company follows an asset-right strategy and benefits from synergies across contract logistics, ground express, and ECU Worldwide's global network. The business has grown consistently on the back of strong customer retention and a digital-first approach. Its proprietary MyCFS platform now covers most client interactions, while Salesforce CRM enables insight-driven engagement. All Cargo Terminals has delivered a 3-year sales CAGR of about 81% and a profit CAGR of 117%. In FY25, volumes rose 27% as new capacity came on stream at Nhava Sheva and at Mundra. Revenues grew in line with volumes while EBITDA per TEU continued to improve thanks to operating leverage. Utilization levels for the company stayed near 90%, reflecting resilient demand. Looking ahead, All Cargo is expanding capacity by 55% over the next 3 years with new facilities at JNPT, Mundra, Chennai, and Farrukhnagar. Investors will need to track how the new capacity of All Cargo Terminals scales up along with its digital-led service differentiation. Wellspun Speciality Solutions. Wellspun Speciality Solutions is India's only fully integrated stainless steel manufacturer that is producing bars, pipes, tubes for the oil and gas, defense, aerospace, and petrochemical sectors. The company has delivered a 3-year sales CAGR of about 64% and a profit CAGR of about 23%. In FY25, revenues grew 4% year-on-year, while EBITDA margins slipped from 4% to 8% as steel realizations remained under pressure. Even so, the company ended the first quarter of FY26 with a strong order book of around 6,500 tons valued at about Rs 2.8 billion. The management is focused on strengthening the company's base at home while looking for new export opportunities abroad. To that end, the company is adding to its product mix with trials in advanced grades. Investors should monitor whether the company can stabilize its margins and deliver consistent growth from its new value-added products. Penny stocks can be exciting, but they are also unforgiving. Rapid growth and eye-catching numbers don't automatically translate into durable returns. Wealth-creating penny stocks have solid business models, clean balance sheets, and managements that can deliver through business cycles. That's why selectivity is everything in penny stocks. Investors need to separate speculation from genuine long-term growth potential. Focus on growth that is backed by cash flows, avoid companies with weak corporate governance, and always insist on a margin of safety in valuations. Happy investing.